Japan's 40-year government bond just crashed in a single trading session. Yields jumped a quarter point in hours, the largest daily move since 1999. And what happened next is something that almost nobody in mainstream financial media connected for you. US Treasury Secretary Scott Bessent picked up the phone and called his Japanese counterpart in a panic because he understood something that most American investors still do not. Japan holds $1.2 trillion in US Treasury bonds, and the country's debt crisis is not staying in Tokyo. If you're watching this for the first time, subscribe to Finance Truths right now because this channel exists to give you the macro financial intelligence that actually moves your portfolio. Drop your thoughts in the comments below on whether you think Japan's crisis hits the US harder than most analysts are predicting. And stay with me through every paragraph because the full picture only becomes clear at the end. Let me start with why this matters to you personally. Because most financial content on Japan talks about it as a distant economic story. And it is absolutely not that. Japan is the single largest foreign holder of US government debt, owning approximately $1.2 trillion in US Treasury securities as of late 2025, according to data from the US Treasury Department's Treasury International Capital System. That number means Japan holds 12.4% of all foreign-held American federal debt, more than China, more than the UK, more than any other nation on Earth. When Japan sneezes, the US Treasury market catches a cold, and right now Japan is doing a lot more than sneezing. So what exactly happened in January 2026, and why did it rattle the most powerful financial official in America? Japan's 40-year bond yield surged above 4% for the first time since that maturity was introduced in 2007, all in a single trading session on January 20th. The 30-year bond yield jumped nearly 30 basis points in a single session, the largest one-day move since 1999, which is not a minor technical event. That is a structural shock to a market built on decades of stability. The trigger was Japan's Prime Minister, Sanae Takaichi, announcing a snap election combined with aggressive fiscal expansion pledges, tax cuts, increased spending, cash handouts, at a moment when Japan's debt-to-GDP ratio already sat at 236.7%. Let that number register, 236.7% debt-to-GDP. That is the highest debt ratio of any developed economy on the planet by a wide margin. For context, JP Morgan notes that Greece, which caused a European financial crisis that took years to resolve, sits at 151%. Japan makes that look modest. Now here is the mechanism you need to understand before we go any further, because this is where most financial commentary stops explaining things clearly. Japan has maintained an extraordinarily low interest rate environment for 3 decades, near zero rates that made it uniquely cheap to borrow yen and invest those borrowed funds in higher yielding assets elsewhere in the world. This strategy became known as the yen carry trade, and at its peak, it represented an estimated $1.2 trillion in borrowed yen deployed into global markets. Hedge funds, pension funds, insurance companies, and institutional investors worldwide borrowed cheap Japanese yen and used it to buy US Treasuries, European bonds, American technology stocks, and emerging market debt. This carry trade has been quietly subsidizing global asset prices for over a decade, providing a steady flow of demand that kept bond yields lower and equity valuations higher than they would otherwise have been. Morningstar's chief U.S. market strategist described it precisely. If it is no longer cheaper to borrow in yen, those investors will unwind the trade by selling the foreign assets they purchased to repay their Japanese-denominated debt. That selling pressure hits U.S. Treasuries first and hardest, because that is where the largest volume of carry trade capital was deployed. And that selling pressure translates directly into higher U.S. Treasury yields, which means higher borrowing costs for the U.S. government, higher mortgage rates for American homeowners, and higher corporate borrowing costs for every business in America. This is the transmission mechanism that Bessent understood when he made that phone call, and that most headlines missed entirely. Now let me walk you through the mathematics of why Japan's debt situation has become genuinely alarming, because the numbers tell a story that is difficult to dismiss. Japan's total government debt reached 1,324 trillion yen at the end of March 2025, a figure so large it almost defies comprehension. More importantly, the Bank of Japan recently raised interest rates to 0.75%, the highest level in 30 years. That sounds tiny, but when you're servicing debt equal to 235% of your entire economy, even a 0.75% rate is enormously expensive. As the AEI notes, Japan's debt servicing costs jumped 10.8% in the most recent reporting period, exceeding 31 trillion yen for the first time ever. Social Security and debt servicing together already consume nearly 60% of all Japanese government spending, leaving almost nothing for productive investment in the economy. And here is the critical structural problem. Japan's inflation, which was absent for 30 years, has now exceeded the Bank of Japan's 2% target for 4 consecutive years, reaching 3.1% recently. That persistent inflation forces the Bank of Japan to continue raising rates, but raising rates makes the debt more expensive to service, which forces the government to issue more debt to cover the higher interest costs, which causes more investor concern, which pushes yields higher, which starts the cycle all over again. That is what bond market analysts call a debt trap, and Japan appears to be walking directly into one. Let me give you a pattern interrupt here, because I know what you might be thinking. Japan has had high debt for decades and nothing has happened, so why would it be different now? That is a legitimate question, and I want to answer it honestly. Japan's debt has been manageable for decades for 3 specific reasons, and all 3 of those reasons are weakening simultaneously right now. The first reason is that Japan's inflation was near zero for 30 years, meaning the government could borrow cheaply without the inflationary spiral that destroys other high-debt nations. That has changed. Inflation is now running persistently above target and showing structural rather than temporary characteristics. The second reason is that domestic Japanese investors, banks, pension funds, insurance companies, have historically been price-insensitive buyers of Japanese government bonds, creating what analysts call a reliable, stable base of demand, regardless of yield levels. That is changing. As domestic yields rise, Japanese institutions are becoming more yield-sensitive and beginning to question their allocations, creating the kind of volatility that the January 2026 crash demonstrated with startling clarity. The third reason is that Japan runs a current account surplus, meaning it earns more from exports than it spends on imports, giving it a structural source of domestic savings to fund its debt. That surplus is now under pressure from the Iran war's energy price shock, with Japan's energy import bill surging as oil hits $109 per barrel, squeezing the very mechanism that has kept Japan's debt sustainable. All 3 pillars are weakening at the same time, and that simultaneity is what makes this moment genuinely different from previous Japan debt scares. Now, let me connect this specifically to U.S. markets, because this is finance truths, and the U.S. implications are the core of what you need to understand. When Japan's bond yields rise, Japanese institutional investors face an immediate incentive. Why buy US Treasuries that yield 4.3% with currency hedging costs eating into that return when you can now buy Japanese bonds at home with rising yields and zero currency risk? Ed Yardeni, president of Yardeni Research, stated this directly. Now that Japanese yields are going up, you are likely to see Japanese bond investors stay home and invest in their own bonds rather than in the US, and that will put upward pressure on US bond yields. Upward pressure on US Treasury yields is not an abstract concern. It is the mechanism that drives mortgage rates higher, corporate borrowing costs higher, and ultimately stock valuations lower. The 30-year US Treasury yield was already approaching the psychologically critical 5% threshold during the January 2026 turmoil, and every basis point above that level represents another increment of financial tightening for the American economy. CNBC noted during the January crisis that Japanese bonds sell-off matters far beyond its borders because of Japan's outsized role in global capital flows. Japanese investors have been among the most aggressive buyers of overseas debt, particularly US Treasuries. The AEI was even more direct. Japan has been a major supplier of liquidity to America's stock and government bond markets. And if there is a time when Japanese economic developments truly matter for our financial markets, it has to be now. Let me now give you the carry trade unwind picture in concrete terms, because this is the channel through which Japan's problem becomes your problem fastest. Morningstar's Dave Sekera drew a precise parallel. If the carry trade unwinds, investors selling foreign assets to repay yen debt could create dynamics similar to what happened when Silicon Valley Bank went insolvent in March 2023 because U.S. interest rates rose very quickly. That parallel matters. The SVB crisis caused a brief but violent dislocation in credit. Markets required emergency government intervention and wiped out significant equity value in the banking sector in days. A full yen carry trade unwind would be larger in scale than anything SVB represented, because the carry trade encompasses not just bank holdings, but hedge funds, pension funds, insurance companies, and institutional investors worldwide. The January 2026 episode was already enough to trigger a large sell-off of U.S. assets, according to Axios, reflecting heightened risk of a pullback of Treasury buying by Japanese institutions. And that was just a partial, temporary episode of market stress, not a full structural unwind. The DeVere Group CEO Nigel Green put it starkly: Japan has been the world's financial shock absorber for a generation, and that role has abruptly ended. He added, the repricing of Japanese debt is a systemic event, not a local story, and investors need to treat it as such. Now let me give you the full picture of what could happen in a severe scenario, so you can calibrate your risk accurately. If Japan's government continues expanding fiscal deficits, bond yields could spike to true crisis levels, forcing the Bank of Japan to intervene by buying bonds again. But here is the paradox. If the BOJ buys bonds to suppress yields, it injects yen into the system, which weakens the yen, which increases imported inflation, which requires even higher rates eventually to contain it. This is the trap that the January 2026 crash illuminated. The BOJ cannot raise rates fast enough to defend the yen without potentially breaking its bond market and cannot suppress bond yields without further weakening the yen. In the worst-case scenario modeled by financial analysts, bond markets rebel, yields spike to crisis levels, the BOJ is forced to intervene, paradoxically weakening the yen further. Massive carry trade liquidation triggers cascading asset sales globally, and US Treasury market instability spreads to credit markets. That scenario would hit US stock markets hard, potentially causing the flat to down 10% scenario for US equities that analysts are now actively modeling. But let me be clear about where this sits today, because intellectual honesty requires distinguishing between structural risk and imminent crisis. The AEI's baseline view is that if Japan gradually normalizes policy in an orderly fashion, dialing back fiscal stimulus and allowing the BOJ to continue rate normalization slowly, Japanese bond yields can rise towards something more competitive with US Treasuries without precipitating a meltdown. Morningstar noted that Japanese real yields, adjusted for inflation, are still well below zero, meaning there is room for yields to rise further in a way that reflects economic normalization rather than crisis. And Japan does have genuine structural advantages. It runs a current account surplus, unlike the US, and it holds more foreign assets than foreigners hold in Japan, giving it a positive net international investment position that provides a buffer against the kind of panic that destroys nations without that financial cushion. So the most likely path forward is not an overnight explosion, but a prolonged grinding pressure, Japanese yields rising gradually, carry trade unwinding partially and in waves, US Treasury demand softening at the margin, and American borrowing costs rising incrementally in ways that are invisible month to month but cumulatively significant. The AEI's conclusion frames the risk precisely. Japanese bond market developments have the potential to strongly influence American financial markets, and investors in U.S. economic policymakers would be ignoring Japanese economic policy decision-making at their peril. Now, what does this mean for how you should be thinking about your portfolio in concrete terms? The 60-40 portfolio that every traditional financial advisor has been selling for 20 years, 60% equities, 40% bonds as a hedge, has already shown its vulnerability. In March 2026, every point on the U.S. yield curve went negative in the same session, short duration and long duration together, meaning bonds were not cushioning equity losses. They were generating their own losses simultaneously. Japan holds the trigger for whether that bond as hedge relationship recovers or permanently breaks down. If Japanese institutions continue repatriating capital to domestic markets, U.S. Treasury demand falls at the margin, yields rise, bond prices fall, and the 40% of your portfolio theoretically protecting you actually moves against you. In that environment, gold, real assets, and international equity diversification away from U.S. concentration become more important, not as speculation, but as basic portfolio resilience. Gold is already at record levels above $5,000 per ounce, with J.P. Morgan targeting $6,300. And the Japan carry trade unwind story is one of the structural drivers behind that move, because gold rises when confidence in the traditional bond market architecture weakens. Emerging markets, particularly those with low dollar-denominated debt and commodity exposure, also tend to benefit when Japanese capital repatriation reduces the relative attractiveness of U.S. dollar assets. Let me bring this full circle to where we started, Scott Bessent's phone call. When the US Treasury Secretary makes an emergency call to his Japanese counterpart because bond market volatility in Tokyo is spilling into US Treasury markets, that is not a routine diplomatic check-in. That is a senior official acknowledging that America's largest foreign creditor is experiencing a debt crisis that could reduce its capacity to fund American deficits in real time in a way that directly impacts the rate at which the US government borrows money. America crossed $39 trillion in debt this year, accumulating at roughly $1 trillion every 100 days. The U.S. is now spending more than $1 trillion annually on interest payments alone, exceeding its entire defense budget. The petrodollar system that used to guarantee foreign demand for that debt is under pressure from Gulf state diversification. And now Japan, the largest single foreign holder of the treasury bonds that finance those deficits, is facing a debt crisis that may force its institutions to redirect capital homeward rather than outward. These are not separate stories. They are converging pressures on the same thing: America's ability to finance its deficit cheaply, and Japan's debt bomb is the most immediately underappreciated of those pressures right now. The bottom line for Finance Truths viewers is this: Japan's debt crisis is not a foreign story you can safely ignore. It is a story about the largest buyer of US government bonds potentially becoming a net seller, and every American who pays a mortgage, holds bonds in a retirement account, or owns equities priced on cheap borrowing assumptions needs to understand what that means. The January 2026 crash was a warning shot, not a crisis, but a preview of the mechanics that could produce one. Monitor Japanese bond yields, watch the yen, track carry trade positioning data, and pay close attention to any BOJ policy decisions in the months ahead, because those decisions will move your portfolio whether you are watching them or not. If this analysis gave you genuine value, subscribe to Finance Truths right now, share this video with one investor in your circle who is still treating Japan's debt situation as someone else's problem, and comment below whether you think the US Federal Reserve is adequately prepared for this scenario where Japan's largest institutions begin meaningfully reducing their Treasury holdings. The most important financial risks are never the ones everyone is already talking about. They are the ones developing quietly in markets most people stopped watching. Japan's bond market is one of those risks, and Finance Truths just made sure you're not caught off guard by it. Stay analytical. Stay ahead. This is Finance Truths.